Netflix is a big winner in the first quarter of the year, tracking gains of more than 20% and outperforming 5 of the 7 members of the Magnificent Seven. Well, Wall Street is bullish on Netflix, with 2/3 of analysts rating the stock a buy. Our next guest has been one of the most bullish price targets on the street and is nevertheless removing the streamer from a list of best ideas. Here with more of the analysts behind that call is Alicia Reese, Wedbush Securities Vice President of Equity Research. It's great to see you here. So removing Netflix from the best ideas list, do you still, though, it sounds like, see upside for Netflix, and what does that look like?
Yeah, so we raised our target even more. We're still very bullish on the stock. We just don't expect the same outsized growth in the shares that we saw over 2023. I think what we're going to see is a shift to some extent from subscriber growth in 2023 that was really outsized. A lot of that driven by the password sharing crackdown and the ad tier as its limited churn. We think the ad tier will continue to limit churn over 2024 and beyond, but it'll also start to, in the back half of the year and certainly into 2025, contribute to ARPU. And I think the story shifts from a subscriber growth story domestically to an ARPU growth story domestically. That subscriber growth should still maintain some really nice a buffer from the international growth still. So we're still quite outperform on the stock. We just don't see the stock doubling again in 2024.
Yeah, you mentioned international. What levers do you expect Netflix to try and pull in the back half of this year, at least, well, in the next 3 quarters of this year? My goodness, I'm just trying to, speed past the second quarter. But anyway, as we think about the rest of this year, what levers can they pull internationally?
Well, I think they have still, our survey that we did recently said that about 6% of at least domestic Netflix subscribers are still sharing their password and have not yet been cracked down on. And so I don't think Netflix is going to do that all at once. I don't think you're going to see that in one single quarter. They're trickling that in because it's adding, a nice buffer for new subscriber additions for those who get kicked off, and also for families who choose the extra member feature, and that's a nice boost to ARPU. So I think we'll continue to see that just in diminishing rate that we saw in 2023. There's also the ad tier. The ad tier is nearing accretion, so that incremental ARPU that you get from the ad tier, it hasn't added anything to ARPU yet. It's reaching parity. I think in the back half, it'll start becoming accretive, and then in 2025, it'll be more meaningfully accretive, and that can grow pretty substantially beyond 2025. So it's still a really interesting story here, and there's quite a bit of growth in all aspects. And then, like you said, the international, that just growing the subscriber base. I think there's not as much room to, in EMEA, but certainly plenty of room left in Latin America and APAC.
And what's that going to do to Netflix's bottom line, do you think, Alicia?
Yeah, so the ad tier accretion, that drives revenue, that drives earnings, that drives free cash flow. So that's a hugely positive story. Consensus is calling for a doubling of EPS from 23 to 25 or 26. And we think that's absolutely reasonable. A lot of that is just coming from the extra member feature being entirely incremental revenue, and then the accretion from the ad tier being entirely incremental revenue and at a very high margin. They're not spending terribly much on that. And as they add more sports and more sports-like content, like the WWE, that'll give them a lot more opportunity to advertise, and not just on the ad tier, on the premium tiers as well.